Hello, my
Appreciate how hard you work.
Oh, thank you, sir. Hello, my VettaVA friends. It is Helmer, your rate guy, coming to you each and every week just to help you to kind of have some human intelligence into what's going on with mortgage rates so that you can make a good decision if you're thinking of buying a home or refinancing. Of course, I am joined this week with Mr. James Mercado. James, please take a minute and tell everybody a little bit about yourself.
Yeah, I've been in the mortgage business 25 years. I've got a wonderful company that I get to work with. I love partnering with VettaVA. We help and serve veterans all over the nation, actually all over the world. So excited to be able to share some information today.
Well, like I said, thank you for joining us. January 4th, 2020, for those that are watching. Remember that we are here for you guys. So if you have any questions or comments, please go ahead and let us know. If you're here live, say hello. If you're watching on the replay, as I know many of you do, go ahead and just put a hashtag replay in the comments. Let us know that you were here. And if you have any questions about what we talked about today and you're watching on the replay, be sure to tag James Mercado, or you could tag me, and we'll be glad to get you some answers. Or, of course, any of the other vetted VA community moderators will be glad to help you as well. So with that said, you guys are here to find out what's going on with interest rates. Let's give you a quick recap and talk about where we've been and where we're going. So remember, when we talk about rates, it's not an offer to lend. And when we talk rates, we're talking about averages and generalities. You always want to discuss your unique situation with a mortgage professional. Of course, I think it should be one of the VettaVA professionals. And you should absolutely shop your rate. So basically, what have we seen over the last week or two? The last week, rates increased. Generally, I would say a very rough average. If you just did a, kind of a countrywide assessment, they were about 0.25% higher. If you got a rate quote at the end of December and you got a rate quote at last week, you're going to find that rates are about 0.25% higher on average. So VA rates generally in the low to mid sixes. If you're getting a rate quote in the low to mid sixes for a VA mortgage, that is, absolutely in the correct realm or range. If you're getting something significantly higher or lower than that, it should bring up some red flags, and you may want to ask some more questions about that in the group. Conventional rates. If you're not getting a VA mortgage, you may be getting what's called a conventional mortgage. There's basically three very popular mortgage programs out there. There's the VA mortgage, there is the FHA, or Federal Housing Administration insured mortgage, and then there is a conventional mortgage. So conventional rates are generally a little bit higher. They are in the low to mid sevens. If you're getting a mortgage and you're not getting a VA mortgage for some reason, and you're seeing a rate quote in the low to mid sevens, or even in the higher sevens, depending on your credit score and the amount of money you're putting down, that's very much what we are seeing out there. James, what about you? What are you seeing for interest rates out there and in your market?
So what we've noticed now is that interest rates have gone to the lowest level since May of 2020. So that's a good sign. Our almost set in October. We had a pretty aggressive dip in December. We've seen it kind of bounce back a little bit higher, not much higher. Things have stabilized right now, and we are excited for people to be able to take advantage of this. The reality is, though, move slowly, because all the experts are going to say, they are saying right now, that rates are going to continue to eke its way down to cool things off and help, just help pick things up a little bit. So that's what we're seeing going into 2024. Keep your eye open on this, because you might be able to save a little bit of money for yourself.
Awesome. So I will expound on that a little bit. So I agree with James. The worst rates should be behind us. Those were in October of 23. The reason that we saw the worst rates then is that was when the Fed did their final rate hike. Now, the Fed does not set mortgage rates. However, they do influence mortgage rates. They influence rates across the entire economy. That's their role as our central bank. It's one of the ways that they try to keep the economy in check. They want it to grow, but not grow out of control. And those rates, like I said, were the worst behind us. But from here, we're likely to continue to see them creeping up a little bit. They went up a little bit last week. They're probably going to go up a little bit more this week. We're not going to see big movements. We're not seeing big jumps, but they're not as good as they were at that dip, as James said, in December. And the reason that we're seeing that is that markets are starting to let go of the idea that the Fed is going to cut rates at their March meeting. So again, the Fed does not set mortgage rates, but they do strongly influence them. And mortgage rates actually react to speculation of what's going to happen from the Fed. And a lot of that speculation can be, go ahead, James, pop in there.
I'm sorry, that's just crazy that's Helmer, you're spot on that they react to the gossip and that kind of stuff. And it's just crazy how that works when you're dealing with trillions of dollars and they go on speculation and what ifs and maybes. Yeah. So well said.
Yeah, and that's very much. And this is a chart. Again, this is available to anybody that wants to see it. You can Google CME Group Fed Watch, and you can find this chart. What we're monitoring are what are called Fed futures. This is basically the bets that Wall Street, that traders are making on where they think rates are going to go, where they think that Fed funds rate specifically is going to go. Now, across the top here at these tabs, these are the different Fed meetings for the year. We have January, March, May, June, July, September, November, December. Those are the 8 different meetings. These are opportunities. Each time Fed meets, the Fed can do one of 3 things with their Fed funds rate. They could increase it, which would be a rate hike. They could leave it exactly the same, or they could cut that rate. Now, since March of 2022, we have seen rate hikes, and the Fed was raising rates because they wanted to slow the economy down because of the inflation that we had seen post-COVID, post-pandemic. Well, now everybody is looking for, when are we going to see a recession? Because the Fed has basically pumped the brakes on the economy. So we should be seeing signs of a slowdown. However, we aren't. We're seeing what we call a soft landing. And the economy is actually still very resilient. People are out there spending money. The labor market is doing well. People can still find a job if they want a different job. They're not unemployed. Unemployment's at 3.7%, I believe was the last reading. Very close to right. It's been right around that level. So the Fed meeting in January, in a week and a half or so, or actually now we're down to about a week, that meeting will most likely have the Fed members say, we're going to just keep things the same. That's what they did last year. They did it in October and November on through the rest of the year. And markets are looking at when do they think that the Fed will actually start to cut rates. And the reason the Fed would cut rates is because they want to now encourage the economy to warm up a little bit. Because just like if you've hit the brakes, the person in front of you slows down and you hit your brakes, and then everybody reaccelerates and you take your foot and put it on the gas. Well, that's what a rate cut would be for the Fed. Now, the problem is we have not seen any signs that the economy is in trouble or slowing down significantly. And because of that, it's kind of a game of lag. So I actually, when I was talking to you, James, there's a little bit of lag between you and I with the internet. And there's a lot of lag between the Fed's activity and what effect it actually has on the economy. So what markets are betting on is the fact that the Fed won't wait for the data to show that the economy is actually in trouble, because by then it will have already started happening and they'll be reacting too late. They want to kind of get out in front of it. So markets say, hey, we think that the Fed is going to start to cut rates by this March meeting. Now, in December, if we use this little compare button, we can see that in December, this light blue chart here, there was a 75% probability. Markets were betting that the Fed was going to cut that interest rate. And basically they were betting on it 75%. Well, now that's dropped all the way down to 40%. And that's why we've seen mortgage rates creep up. Again, I know that it's hard to understand that relationship, but as the Fed is speculated to take action, as markets expect things to happen, they're trying to make money today. They're trying to get in front of it and act first. So that's why we see it affecting all of the back-end instruments, including mortgage-backed securities and treasuries. And that's what actually does directly affect mortgage rates. So that's kind of where we're at. And when it comes to this and that forecast, James, where did you think that rates are going to go in the near term, in the next couple of weeks?
So, well, I think, right now, things the next couple of weeks is going to be pretty stable. I don't think we're seeing any drastic changes. But I think as we go into the rest of the year, we have a chance for rates to break 6%. So you're going to start, and I'm talking without discount points. So right now, people are advertising rates in the 5s, but they're charging you discount points. And so I'm talking a no-point loan. We should see rates get into the 5s. In my prediction, it's not gospel. It may not happen, but 25 years I've been doing this. This is what I've foreseen to happen. So I want to tell people, move slowly, especially if you're going to do a VA IRRRL, because then you're locked in for 6 payments, 210 days from the first payment date. So if you say jump in it now and all of a sudden it drops another point in 3 months, you got to wait. So the reality is, do your homework, talk to a professional, and do your own research and see what you can come up with. Because right now, inflation is the biggest concern. They feel like they kind of have a little bit more steady control of this, which if they do that, that means they'll drop the rates. If they drop the federal funds rate, that's what Helmer was talking about. That's going to like kind of pushing the gas pedal a little bit on the economy, because they think they might have slowed it down a little too fast, because they went pretty drastic. All those rate hikes was like putting the brakes on when you're on the highway. And now like, oh, maybe we hit the brakes a little too hard, but we're not sure yet. So we're not going to do anything in March yet, because we're still going at a decent speed. But we're definitely thinking that we need to cut rates and push the gas pedal a little bit for the rest of the economy. And that's what I think is going to happen this summer. So
yeah. And I think I agree. So in the next, couple of weeks, I think, like James said, I think rates are very likely to hold steady. They may move slightly higher, but it shouldn't be too big of a move. Now, over the next few weeks heading into February, rates are not likely to move lower unless markets like what the Fed says at this January meeting next week. And we'll talk more about that on next week's show. But basically, they're looking for signals that the Fed is open to cutting rates sooner than later. And
more
then
subjective stuff, Helmer. Like, are they now? It's like no one really knows, but they want to get that good feeling. But the end of the day is we don't know for sure. So I don't expect a lot of change, to be honest with you.
Yeah, I don't think that we'll see it by then either. And then longer term, rates should move lower as we continue through 2024, like James said. Not anywhere near the pandemic lows. Don't look for them to drop and for the floor to fall away. However, like James said about the VA rates that fall back into the 5s without having to pay any fees or points. We expect to see rates continue to improve through the year, but it's going to be in fits and starts, meaning we'll see rates do what they're doing now. They dropped in December from October highs, then they kind of held there, then they crept up a little bit, then they held there. Now we'll see them when the next time that the markets do feel that we do see a rate cut, we'll see rates get a little bit lower again, and then they'll hold there. So you're going to see it move in little bits and pieces, and it's never in a straight line. And that's why you don't want to try necessarily too hard to time the market. If you're out there looking to buy a home, you generally want to continue to go ahead and get out there and buy a house. And James, why is now a good time for somebody to buy a home?
Let me explain that for a second, and I want to just give you a really catchy phrase: date the rate, marry the house. There's a low supply of inventory. Find that house that you like. Don't get too freaked out about the rate. Find the house, marry that house. This is the house we want. And you're just going to date this interest rate, because we're going to see rates dip a little bit. And when they dip to a level, you'll be ready to go, but you'll have the house you want. And the reason that's important right now is we have a low supply of housing inventory, but we still have a high demand. There is a very high demand for people who want houses that there's just not enough housing for. Unlike 2008, where there's plenty of houses and lower demand and everything blew up for various reasons. We're not here to talk about that. But right now, people are still buying. People are still wanting to, they have triplets and they need a bigger house, or they don't want to rent anymore. So they want to divorce their landlord. They want to marry their own house, but they're going to date the interest rate. And that's why you should move now, because when rates do drop, that's going to take prices of houses and it's going to push them through the roof, because now the cost of money is cheaper and more people will jump in that couldn't afford a house before. Now they can afford it at a lower price point, drives prices up. You need to lock in a price house now, marry that house, date that rate, and divorce your landlord.
There you go. So well said. Not anything that I would do that wouldn't just be repeating it. So we're going to wrap up pretty quick today. I think we got through everything, really, really well. What would you leave everybody with if you were having a conversation with someone, if they said, I'm scared to be buying a home now, though. Why shouldn't I wait until rates go down? I mean, I want to wait until they drop. Let's leave on that. What would you say to them?
I'm a little biased. I'm an old school guy. I think it starts with relationships, and I would pick up the phone. Well, I would go talk to a vetted VA professional, because they are tested, tried, and true, and they're held accountable, and just have a conversation. Say, listen, I am concerned. Let me talk to somebody who's an expert in the industry. What I can tell you is there's lots of experts, but inside vetted VA, we do have accountability that we're going to do what's best for the veteran. We are going to educate you and empower you to make the best financial decision. And for you, maybe it's not the best time right now. Maybe it isn't. But if it is, we're going to share that with you with no strings attached. You don't have to do a loan with any of us. You don't have to do anything, but get the information that you need so you are empowered to make a good financial decision and be at peace with the choice that you make in this window of time when you're thinking about it. Starts
Awesome.
with a conversation.
There you go. Well, you guys, thank you again, James, for joining us this week. Everybody, we do this each and every week. If you want to know what's going on in the rate market and you're curious on just getting an unbiased opinion, you can join us each and every week. It is 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And I'll see you next week. So, James, one more time, thank you. And bye, everybody.
Thank you, Ham. I appreciate everything you do for this community. Well done.
Thank you.